Hello and welcome to the basics of U.S. personal income tax. We're in class 3 and class 3 is going to deal with standard deductions, and this will be lesson 6. I'm Ginger Garvey and I'm the senior partner with Freedom Financial Partners. This particular video series is going to focus on the standard deduction and how to calculate your income tax. So deductions are the amount that can be subtracted from your adjustable gross income, and that amount after it's deducted is used to figure your taxable income. You may be able to subtract either the standard deduction or itemized deductions, but not both. When allowed to make the choice, use the method that gives you the lower tax. So if you have the option of a standard or an itemized deduction, you would want to calculate both and use whichever one is most advantageous. So the standard deduction is based on your filing status and whether you're age 65, if you happen to be blind, and whether you can be claimed on a dependent on another taxpayer's return. On the second page of the 1040 up at the top, you'll see the amount of standard deductions. So right there next to line 40, which is where you'll place either your standard or your itemized deduction, you'll see that in the case of 2014, the itemization, the standard deduction for single or married filing separately is $6,200. For married filing jointly or qualifying widower, it's $12,400, and for head of household, it's $9,100. A standard deduction chart is included here. We're also showing what happens in the event that you are over 65 or happen to be blind. What you would do is you would use the second table. This is all out of Chapter 20 from Publication 17. And you would check the number of boxes that are relevant. So you get one box checked if you're over 65 and one box checked if you're blind. You see here that married filing jointly and married filing separately, you actually have the option of up to 4 boxes that can be checked. Once you check the number of boxes, it will give you the amount of the standard deduction under those circumstances. So for example, if you're married filing jointly and you both are over 65, your standard deduction becomes $14,800. So in this instance, Rich is 56 years old and he's married to Betty, who's 52. They're filing a joint return. Neither is blind or can be claimed as a dependent on another return. So we're looking for what is the amount for standard deduction for married filing jointly, neither of which have an exception applying. And the amount's going to be $12,400. Leonard and Dawn are both over 65 years old, and they are filing a joint return. Neither is blind or can be claimed as a dependent. They check the appropriate boxes and enter 2. According to the standard deduction worksheet, what is their standard deduction? As we just went through this, it's $14,800. You can see here they're both born before January 2nd, 1950, so we would enter a 2, and the amount would be $14,800. In the event that you are a dependent, your standard deduction is calculated using this worksheet. You would actually check whether or not you are over 65 or blind. You would enter your earned income, you would add $350, and you would, the minimum standard deduction is $1,000, and you would calculate it based on this worksheet. So for example, here's an individual who earned $150 of earned income, and we're going to use that, add an additional $350 of unearned income for a total of $500. The minimum standard is $1,000, so we're going to use $1,000 in their instance. So we're going to enter the amount of $6,200, which would be according to their filing status. You would choose the smaller of the two amounts of $6,200 or $1,000, and in this case it's $1,000. You are not eligible to take the standard deduction if you are married and filing a separate return and your spouse itemizes deductions. You're also not eligible to take the standard deduction if you are a resident, a non-resident, or a dual status alien during the year. For most taxpayers, the exemption amount is determined by multiplying 3,950 by the number of exemptions entered onto line 6D, and the total amount would go on to line 42. Your taxable income is actually equal to your adjusted gross income minus your standard or your itemized deductions minus your exemptions. So your income tax and your withheld taxes is the next topic that we're going to be discussing. These are going to depend on your taxable income and whether you're required to use a Schedule D or capital gains and losses to report a capital gain. If none of those special tax situations apply, you would use a tax table or a tax computation worksheet to actually calculate your income tax. Today, almost everyone uses software, and the software has these tables built into it. But in case you're interested in the old school manual way of calculating your income tax, I'm going to provide that, demystify it for you. So to figure your income tax, you're going to look at your filing status and your taxable income. We actually have tax rate schedules. And as you can see, the United States uses a graduated tax schedule, which means that no matter what your total income is, in the case of being single, the first $9,075 are equal to 10%. Your between $9,075 is equal to $36,900. So an individual who's making $50,000 is going to have the money that is taxed up to $9,075 at the 10%. And then the amount from $9,075 to $36,900 is going to be taxed at 15%. And the amount that is over the $36,900 up to the $50,000 is going to be taxed at 25%. That's how our tax rate schedules work. This is a tax rate table. It's calculated for you, and it's available in the publication 17, and it goes all the way up to $100,000. The tax rate table is used if your income is less than $100,000 and your taxable income is arranged in rows of taxable income groups, and that's where you get the term the tax bracket. Your filing status is arranged in columns. The tax on the taxable income is found where the income bracket row and the filing status column intersect. So we're going to do one of these, and we're going to do it manually using the tax tables. In this case, Travis and Kate are married and filing a joint return. Their taxable income on Form 1040, line 43, is $30,980. So they're going to use the tax table because it's less than $100,000. How much tax are Katie and Travis liable for on their income tax return of $30,980? So we're going to actually look and see married filing jointly, and then because they earned $30,980, it's going to be over the first number and lower than the second number. So $30,980 is more than $30,950 and less than $31,000. Looking at the column married filing jointly, we're going to see that the amount of tax that they would pay in 2014 is $3,739. So in that case, it's going to be option B, $3,739. Your correct bracket is the one in which your taxable income is at least the lower number and less than the higher number. If the taxable income is the same as the higher number, then you would use the next higher tax bracket. After income reaches a certain level, $100,000, and filing status makes a difference in the tax. Married filing jointly is generally taxed at the lowest rate, while married filing separately is at the highest tax rate. I always have people say, I want to file married filings but single. It's actually married filing separately. Tax computation worksheets. In the event that your tax is actually over $100,000, you would use a tax computation worksheet if you're doing it manually. These worksheets are also available in the publication 17. So here is, and I just copied two of them in here, section A and section B, for single and married filing jointly. So what you're going to do is you're going to determine where the income falls in column A. You're going to enter the amount in the taxable income column, and then in column A you're going to actually enter the amount from line 43. You're going to multiply it by the amount in column B, and you're going to write the answer in C. Then in column D, you're going to subtract the amount that would be taxed at lower rates, and you will come up with the amount of the tax in the final column. So we're going to go through one of these. In 2014, Joseph must use the tax computation worksheet because his taxable income on line 43 is $132,678. So he finds the tax rate schedule for his filing status, which is section A for single. How much will Joseph's income tax be? So we're going to put his amount from line 43 in the first column A, 132,678, because it is between 1,000 and not over 186,350. We're going to multiply it by 28%, which gives us 37,150. We're going to subtract the 6,824.25, and it's going to give him a tax of 30,326. So that's how the tax computation worksheets are used. In this case, it's 30,326. Determining the refund or the balance due. If there were withheld taxes exceed your tax liability, you would be due a refund of the overpayment. If you did not have enough tax withheld to pay your tax liability, you pay the difference with your tax when you file your tax return, or at least before April 15th. So your standard deduction depends upon your filing status, your age, and whether or not you are blind. If you can be claimed as a dependent or on another taxpayer's return, that's also going to modify your standard deduction. You can use the 2014 standard deduction charts to determine the amount of the standard deduction, and that would be the same for each tax year. And the amount of your tax would depend on the amount of your taxable income and your filing status. If your taxable income is less than $100,000, you can use the tax tables to figure your tax. If your taxable income is above $100,000, you can use the tax computation worksheets. All of this information is included in the publication 17 from the IRS. If your total payments are more than the total tax that you owe, and then by those total payments, that would be equal to withholdings plus refundable credits, then you would have a refund. If your total payments are less than the amount of your tax, you would have a balance due. So we'll get into the total tax and the refunds and the balance due in more detail in the chapter and lessons that have to do with credits. So this information is pulled from the IRS publication 17. We primarily focused on chapter 20 and chapter 30. The tax tables and the tax worksheets are located further back into the publication. In the event that you have questions, please don't hesitate to send us an email at ginger@freedomfinancialpartnersllc.com, and you can also find additional information on our website. And good luck with the tax season. Thank you so much for participating this evening.